What kind of entity do we usually use to put these deals together? Sometimes people think you use a corporation because you get the protection. There's a little bit of misnomer about the sort of thing. Understand, we don't use corporations. We use limited liability companies, LLCs. In the old days, pre-1990s, we used to use limited partnerships because that was the structure that was used. There was a general partner and a limited partner. The investors were always limited partners. Those are the passive people. The active people were the general partners. That nomenclature has changed because many of the states adopted these new LLCs, and the limited liability companies, the LLCs, are really well-designed hybrid organizations. They're taxed like partnerships, but you get the protection of corporations, and that's the critical part. You never ever put real estate into a corporation, with rare exception, because it just doesn't get the kind of treatment, the tax treatment that you want. Now, maybe larger organizations, a little bit different story, but for those of us who operate in the smaller environment, we just don't use corporations. So typically, these are always done in limited liability companies, and we sell stock in these limited liability companies, and it really works out very well for all of us. So the structure is really simple, and we use these kinds of entities. They're easy for local domestic people to participate in. They're easy for foreign people to participate in. At the end of the year, all the income that got made gets distributed to the investors. Very important point. Whether they get cash or not has nothing to do with how much tax they pay. Very important consideration. So let's say the deal makes $1 million. You recycle that million into another deal. They're still going to get taxed on $1 million. So if there's 20 different people, you're going to divide the tax or the amount of profit by the number of people that were in the deal based on how much they purchased, and then you're going to issue the tax reports, and those are called K1s. So there's a Schedule K that takes all the income of the whole partnership, the LLC, and then it spreads it out on the K1. So and that's what gets filed with the state and federal governments. So very important to understand a little bit about the corporate structure, the partnership taxation element of this, the way the K1s get done. It's not terribly complicated. Almost every accountant in America understands how this works. Attorneys understand how this works. So when they see these, when your investors look at them, all of them learned about how this works. And that's part of the whole deal, is you want to set up a structure that is familiar to the people who are advising your investors, because every accountant, every attorney, they all learned about these structures when they were in college, and all of their clients are doing these kinds of things. I've never met an accountant that doesn't know something about this. They may not have ever done the tax work for a fund, but certainly their clients are on the receiving end of these K1s, so that everybody understands how it works. So anyway, a little overview on structure. This is a great business. Now go out and stake your claim.